Hi folks, welcome to this video on an amortized cost bond investment where the bond trades at a premium. So now we're going to do a few things with this problem. We are going to make the journal entry to issue the bond investment. We are also going to create an amortization table so that we can prepare journal entries to record interest income for every period that the bond is outstanding. So let's begin. Our question said to make the journal entry to issue the bond, or not to issue the bond, but to record the bond investment. Now, you'll have to remember in this case that we're making the entry on the investor's books. So they happen to give you the amount that you paid as the investor for the bond in the question. But if you weren't given that, you could use your calculator to do it. So if you set P/Y equal to 1, and that's because there's only one interest payment throughout the year, we can calculate this as the future value, meaning that at the end of the 5th year, because there's 5 years in the term of the bond, we are going to get $500,000 in cash, so we're bringing the bond back to its face value. We'd have to tell the calculator what our payment per year is, meaning how much cash are we receiving as investors. And again, in order to get your PMT, you need to use the 12% here, which is the coupon rate. We use the yield or the market rate for the interest income, but for the cash received, we use the coupon, which is 12%. So 500,000 face value times 12% means we're getting 60,000 as a payment every year. We're going to set our term of the bond, or the number of interest payments received throughout the term of the bond, as 5. Our yield is 10, and we do a compute PV, and we will get $537,907. And I think you might not get 40 cents, you might get 97 or 98 cents, but that's okay, not to worry. The authors of the text probably use a bond table, and they don't use a calculator. So you will get a slightly different answer, but the calculator is always more exact, right? So now, in the second part, we're going to do our bond interest calculation, and we're going to also include the interest payment. So if we do the schedule to amortize the bond, again using the effective interest method, we're going to put the date, which is the issue date, cash received, interest income, any premium we amortize, and the carrying amount of the bond. So at the issue date, we have the carrying value of the bond, which is what we calculated as proceeds on the bond. And again, it's a premium bond, so proceeds will exceed face value, right? And in our case, we know that each period we get a $60,000 payment. Notice we didn't receive any cash, book any interest income, or amortize any premium at the issue date. All we did is record the bond. Right? So all we did is set up the bond, which is why we've got the carrying value column completed and none of the others at the issue date. But once we get to interest payment dates, which is each December 31st, so we'll receive cash of $60,000, but as the investor, we have to book interest income. So how much interest income are we going to book? Well, we've calculated $53,790.74. How did we get that? Well, we used the carrying value of the bond to open the 2017 period within which the interest payment date falls, and we multiplied it by the yield. So don't forget to calculate interest income. We use the yield. To calculate cash received or interest received, we use the coupon, right? So this number here times 10% is going to give us $53,790.74. So we're booking interest income of $53,790.74. We're receiving cash of $60,000. So the difference between those two is the amount of premium we're amortizing. So now if we deduct this premium from the carrying value, we're going to get a carrying value for the bond at the end of year 2017 at $531,698.14. So notice the carrying value of the bond is decreasing or going down to bring it closer to the face value. We will use the carrying value of the bond here in order to calculate the interest income. So the carrying value here times 10% is going to give us $53,169.81. So the difference between this interest income and cash received in 2018 is $6,830.19. So we're going to amortize that premium to the bond. So now the bond is being carried at $531,698.14 less what we amortized as premium, and we're going to get $524,867.95. Right? So if we continue to do this all the way through with making some appropriate adjustments for rounding, we're going to see that over the term of the bond, we received $300,000 in cash. We booked interest income of $262,092.60, and we amortized premium the entire $37,907.40 was fully amortized. In other words, the difference between the proceeds and the face value was fully amortized. We can now use what we have from the table in order to make our journal entries. So at each interest receipt date, we're going to make an entry to debit the amount of interest we received, which is $60,000. Notice now we're crediting or reducing the bond investment because it's going down, because it's a premium bond. We got proceeds at the issue date in excess of the face value, so we're going to reduce the bond investment to its $500,000 face value. So by the time we get to the end of the 5th year, okay, the bond is discharged. So now we're going to credit the bond for the amount of premium we amortized and credit interest income for what we calculated, which is $53,790.74. Similarly, at the end of 2018, we're going to do the same kind of thing. We're going to go across, doesn't let me do that. We're going to go across this row here, debit our cash for $60,000, credit our interest income for 10% of the carrying value to open the 2018 period, which is this guy, right? And credit the amount of the premium we amortized, which is $6,830.19. They then asked us not to do 2019 and 20. They just wanted us to do the entry now to extinguish the bond. So, because the bond now was only a 5-year bond, and the question said that the bond matures January 1st, 2022. So now, with that in mind, on January 1st, 2022, the day after the interest payment was made to the investor, right, we're going to now want our $500,000 back, right? So we as the investor are going to debit cash and credit the bond investment for $500,000 to take the bond off our books because it's fully paid up. Now again, the authors didn't ask you to do the journal entries for 2019, 2020, and 2021 for interest, but again, not to worry, they would be the same entries in the same format as you had for December 31st, 2017 and December 31st, 2018. So for 2019, for this period here, if you had to do the entry, what would you do? Well, you would debit cash for $60,000, you'd credit interest income for $52,486.80, and you would also credit the bond premium amortized for $75,13.20. If you had to do another entry in here, the question just didn't ask you for it. So by the time you actually terminate the bond or get your money back from the issuer of the bond, for which the $500,000 face value, you've already got your interest payment at December 31st, 2021. So again, since you're at the end of the term, they just asked you what entry you would make on January 1st to record the maturity of the bond. And that's the entry we make. Debit cash and credit bond investment at amortized cost for $500,000. Now, I did have a question in the class. Do I have to put the bond investment is at amortized cost? You can if you wish. You don't have to. But most of the time what we see is the fact that the bond investment is being handled, the interest is being calculated using the effective interest method. That would be disclosed in the notes so the reader would know it's amortized cost because we're amortizing the premium. So it's not necessary. A lot of times these are in note disclosures, but no problem including it in the account if you wish. So anyway, I hope this helps you, and good luck with your studies.